Is there any scenario that you can think of, and what would it be, where you would think that the American dollar would collapse and you would recommend people to get into metals?
Well, here's the problem that you have with this. My basic thesis for the last 18 months has been that our economy is in a great deal of trouble and we're screwed severely. But the rest of the world is screwed much worse than we are. Mm-hmm. And this has so far played out essentially perfectly. We now have rumblings coming from over in Eastern Europe that there are a number of Eastern European currencies that are nearing collapse. And the fundamental difference between our economy and our nation and those nations is that the debt that we hold in America is denominated in dollars. So if we get into a situation where we're going to play hyperinflate or try to, it can at least be attempted. In those other nations, there's a big problem because a lot of these countries were not able to fund in a bond market internally within their own nation. They couldn't get the investor support to do that on any kind of a consistent basis. So a lot of loans were actually written in outside currencies, in many cases in dollars. Okay? Well, the problem that occurs when you have your currency go from, say, $1.50 euro to United States dollars to 127.80 where it is right, well, 127.91 where it is right now. I just looked up at the screen, it's moved. Is that the value of your debt goes up. Okay, so you haven't actually done anything, but the number of dollars that you have to buy in order to pay down that debt goes up dramatically. This is how you end up in a situation where people start doing things like what happened in Weimar Germany, where the German government all of a sudden loosed all these marks into the system. They had tried to inflate the economy. People literally stuffed them in mattresses. They refused to spend. It's very similar to what's going on now with the banks, where we have all this money being thrown into the economy by the Fed, and the banks just refuse to lend it because, first off, they don't know who's good for it and who's not. And secondly, for those people that are good for it, they don't have any desire to borrow. If that money all of a sudden was to get chased out into the economy all at once, it could produce that kind of a scenario. The problem with that is that it isn't in the best interests of the people that run these institutions, the Federal Reserve and the banking system, to precipitate that kind of an event, because the only thing they have to sell is money. If they destroy the value of the currency outright, they end up with nothing too. So essentially, if you are taking a bet on precious metals, for example, gold going to $5,000 an ounce, as some people have said, that we should, that the parity value, I've seen people put forth very complicated arguments that devolve down into the real value of gold is $3,000 an ounce or $5,000 an ounce, and the government has suppressed it by selling gold anytime it goes up, and we've got these malefactors that are shorting contracts in the COMEX. The problem with this theory is that it all depends on the premise that at some point all of this money will get scared into the economy and go try to buy things like houses. Okay? Well, we've got a $55, $56 trillion debt problem in America between private business and the government at present. We have taken the Federal Reserve's balance sheet from $800 billion to about $1.5 trillion, and yet about $10 trillion worth of stock market wealth has been lost in the last 6 months. So we've put $800 billion into the currency system, but we have destroyed $10 trillion worth of value in stocks, and we haven't even started talking about houses yet. Okay, there's been another $10 trillion that's been destroyed in all probability in residential real estate around the world, not just in the U.S. In the U.S., it's probably about $2 or $3 trillion. So in order to hyperinflate, in order to create a hyperinflation where the currency would actually collapse, you'd have to have some way where that positive feedback loop between prices and the amount of currency in the system gets established. If they were to try to do that without being able to couple it back into wages, what you end up doing is collapsing demand. Because let's say, for example, that you were to have that kind of a situation. Ben Bernanke decides tomorrow that he's going to print up $1 million for every household, and he's just going to literally send everyone in the United States $1 million check. Okay, I mean, that's the nightmare scenario that a lot of people think about. What ends up happening there is that your wages don't go up. You still make $50,000 a year, but now a loaf of bread is $10. Okay, well, how many loaves of bread can you buy? Then demand collapses in the economy. We're right back where we started, but now everybody's broke. So I don't buy that scenario unless there is a tremendous mistake made with committed lines out in other parts of the world that go under. And that is the place where there is risk of this. The scenario where I can see it occurring is, just to put an example on this, Bernanke has put out into the marketplace 500 billion, 600 billion, somewhere in that area, of swap lines, which is essentially short-term credit to other central banks around the globe. He did it with South Korea not too long ago, as an attempt to prevent Korean defaults because they have external debt. And this comes back to what I was talking about with debt being denominated in other than your native currency. He stabilized the system over there by doing that. But the problem is if Korea can't pay that line back, that's a direct loss. Okay, so there is a risk that kind of a thing happens. If it stays in the range of where it is now, you could see fairly significant inflation. I'm talking about 1970s style inflation. Okay, where we have 15%, maybe even a little higher than that, inflation in things that you need, things that have to be imported, and specifically, of course, the big one for us is energy. It's oil. We're able to grow our own food for the most part in this country. We don't need to import food. However, the price of energy shows up in everything because oil and natural gas are necessary to make fertilizer. They're necessary to make fuel, to run the tractors, to drive the trucks to get it to the store, or whatever have you. So there could be a squeeze that comes there, but it's more likely to be a 1970s-style stagflationary thing where the economy just basically goes to hell. And in that environment, I'm not so sure gold does all that well. When we had the last major blow-off in gold, it was right around 1980, and that was more a geopolitical thing. That had to do more with the Iranians deciding to grab a bunch of our people and imprison them than it did anything else regarding the economy. And there had been an advance in gold prices throughout the 1970s, but you can't look at that entire area because, of course, Nixon took us off he closed the gold window, and when he did that, then gold started to correct to a market-based price. So, looking at the rise in gold from the pegged value when we had the gold window up to where it reached market equilibrium is a distortion that somehow you have to factor out. And I don't have a good way to do it, unfortunately. Mm-hmm. My problem with the thesis is that we've never seen deflation since the 1930s in the United States. It has never happened. And yet gold went from $800 an ounce in right around 1980 down to about $300 when we got down into in the 1990s and the 2000 area. And what I'm concerned about is you could see that kind of volatility again. So to have some of it around in the event that we have a total collapse in the system seems to make some sense to me. To have silver in particular is probably more valuable in that regard, in that it's in smaller denominations. And if you need to buy a chicken, I don't know how somebody's going to make change for a gold coin. On the other hand, some silver dollars might go somewhere. Does that make sense?
If you do see such a scenario develop, do you think that you'd be able to see it develop and let us know on your market ticker?
Yeah, I expect that if those kinds of things typically don't happen instantaneously. Okay, Iceland, of course, is the exception that a lot of people like to point to, where they had essentially 75% of the value of the currency evaporated in an afternoon, and 75% of the stock market at the same time. But Iceland was a very special case in that they had, again, a great deal of their debt was denominated overseas. It was denominated in the local currency, but they had bought a lot of dollar-denominated debt, and they were essentially trying to act as a banking superstore where they had debt levels that were dozens of times their GDP. They were essentially trying to act as a banking center that was capitalized at a level of 10 or 15 times the actual amount of capital that they had in their economy. That's unsustainable, and it's kind of like gambling at the roulette table with a marker that you don't have any money to back up. You lose your house when it goes bad. So I see that as more of a special case than a generalized thing. But can we have that kind of a thing happen? Yes. What I would say to be very careful of, and what I would caution to watch for, is if we start to see the collapse of other currencies and other economies, especially in Eastern Europe, especially, for example, if Spain and Ireland get in trouble, if the EU blows up and breaks apart, that would be a place where I think there would be great danger. What I don't have an answer to is whether or not people would run into the dollar in such a scenario, making it extremely strong, because it would be the only place left to go. And there is a possibility that that could happen as well. A lot of people have predicted that we'd see the DX, the dollar index, go to 40. And that was, a year and a half ago. And I said, no, what you're going to see is, it's going to come down as we start cutting interest rates. But as people realize that the rest of the world is more screwed than we are, other currencies will actually depreciate against the dollar, and the dollar will get stronger. And so far, that's how it's played out. As the data changes, so will my thesis. I mean, if I see changes in the macro environment that point to the dollar potentially becoming worthless, absolutely, that'll be something that will be time to scream from the rafters about. I don't see the scenario on the table today that leads to that outcome.